One.
Welcome. It's Ayn Rand Center UK and Hard Money with Jim Brown and Jonathan Honig. We're delighted to have you with us from all over the world. Of course, we're the Ayn Rand Center UK, but we've got students of objectivism, fans of Ayn Rand, literally tuning in from almost every continent on the globe. And we've got a topic today that involves everybody on the globe. This is truly a worldwide economic phenomena. And it might sound a little out there when we're talking about inflation, a little bit, what does this have to do to me? But it's probably one of the few economic ideas that does impact everyone. I mean, and Jim, I'll toss it to you. And for those who don't know Jim, he's a real friend of the Ayn Rand Center UK. You've seen him on with Seth and many others on our programs. He's a longtime objectivist with a major background in finance, Harvard Business School, the Air Force Academy, a lot of major private investment foundations. Jim, you've seen inflation before, you've studied it, but most investors today, most people, they don't even know what it is, let alone how to prepare for it.
Yeah, I feel like I feel really old when I talk to people. I think we were talking before the broadcast. I think the average investor, if average fund manager, is in his 40s today. I mean, you have to be a lot older than that to remember double-digit inflation year after year, where it ground on you and you just considered it part of the backdrop. And that was the case from the early 70s. About the time we got wage and price controls, all the way up until about 1981, until right after Volcker broke the back of inflation with raising interest rates. So yes, it was a long period. It seemed like it was built into the economy.
Yeah, I mean, Gerald Ford, President Ford, famously called it public enemy number one. But you think today's investors, young people, for them remembering that era, I mean, Jim, respectfully, that might have been when you were a young person remembering, in effect, the 1800s.
Yeah. Okay, so I graduated from college in 1971. So yeah, I was just the age of probably a lot of listeners here. And do you remember Gerald Ford with his whip inflation, now his win buttons? He used to have these little buttons that they hand out to his staff, win. That's how big a deal it was. It was an all-out effort, again, allegedly, jawboning mostly, plus the wage and price controls, but to control inflation. And I think I want to just use that to make a point. So, we've seen quantitative easing and we've seen asset inflation for the last 12 years, and that's been great for Wall Street. We have not seen high consumer price inflation for many years. Now we're seeing high consumer price inflation. That is very bad for Main Street. And I cannot emphasize how much, in my opinion, this is a killer for politicians. There's 40% of the people in the country who don't have more than about $1,000 to spend.
Right.
What are they going to do when prices are rising at 10%? I mean, they're going to get mad and they're going to blame everybody who they pay, but they're going to hold politicians responsible.
Let's get into it. And we both, I think, agreed that one great demonstration, if you will, inflation is just kind of the burning up of money, right? The burning up of values. And of course, everything Jim and I are saying today is not investment advice. This is for informational purposes only. I'm sharing some broad ideas. So you always want to do your own due diligence, talk with a financial advisor, and et cetera. But Jim, you're right. I mean, the headlines now, it's inflation all the time. Consumer prices were up 7.5% over the last year. So basically that means, right, unless you got a 7% raise, you're barely keeping pace. And, the Super Bowl party this year, I mean, electricity is up, fruits and vegetables up, gas, of course, is up 37%. So is this what basically inflation is? It's this broad range of consumer price increases?
Well, I have a little bit of a dispute with that, and let me make 2 points. First, I think inflation when you talk about general price rises, you should talk about all the things you spend money on. And as I've shown in one of my pieces, when you have first raised asset prices and lowered interest rates, you have made it very, very difficult to accumulate money and save. And so what I call the cost of saving has gone up tremendously. Now, saving money, putting money aside is something that people normally do. But the cost of saving money and putting it aside to say, I don't know, create a $1 million nest egg 30 years from now, that has gone way, way up. That's tripled by the calculation I've made. So that's one thing. It's not just the cost of consumer prices that's gone up that is inflation. Inflation has been with people a long time, people who actually want to put away money for their future. So that's an important point. Now we're going to have low interest rates, hard to save, and you're going to have an impact on your consumption budget.
You made that point about inflation and or about savings. And Rand, of course, has a lot to say not only about savings, but about inflation as well. One of my favorite quotes of her, actually, I had imprinted on a little kind of a key envelope that you put a safe deposit box in, but she writes that agriculture is the first step towards civilization, but anything above the level of a savage's precarious hand-to-mouth existence requires savings. Savings buys time. And that is exactly, in effect, what inflation kills, right? The ability to save the values you create.
So exactly. And so, gosh, don't get me started. So the Fed tells us that consumer prices are inflation. They don't consider the cost of saving. They're telling us that we're savage brutes, right? They're telling us that we don't think beyond the rage of the moment. They think we're really stupid and irrational. Now, sorry, I'm going to back off. I get really, really angry at that kind of patronizing viewpoint of the public, but clearly, yes. To your point, let me back off getting mad.
Just going to say, the public is blaming already. Here's a few more charts. This is like from Robert Reich. What's driving inflation? Corporate greed. In fact, this is a recent survey. So who's kind of getting the blame for headline inflation, higher prices? It's greedy capitalists. Where is it coming from, if not them?
I think it's people's inability to understand what's happening, because all they know is the prices they pay. And so they go to the grocery store, bacon's up 20%. Oh, it's either the grocer or it's those doggone, pig farmers. They're ripping us off. Or it's the meat packers. They're ripping us off. All they can see is the person they pay, so they tend to blame that person. They aren't equipped to understand the secondary effects. I'm kind of sympathetic to that, to their lack of understanding. I think it's our job to help them understand. I'd like to make an additional point about, you asked earlier about the CPI. I don't think the CPI is a great indicator of people's inflation experience. However, it is you see all the excitement around it. You see the investment community react to it so strongly. And you see, I have Bloomberg News on all day, and I just, people go off the charts about the CPI. Well, it's the number that people focus on. It's a focus of excitement, and so that number, whatever it is going to be something that Joe Biden talks about, that everybody talks about. That's inflation, as far as they're concerned. So that number actually is important in the public discourse. Now, the point I want to make is that high numbers, inflation numbers, are baked in to the CPI. You had some categories up there, food. The biggest category is shelter. And we've talked about this before on my broadcast. Shelter is about 1/3 of the CPI. And on your slide there, I think it only showed up 3%. Well, that's not accurate, because that doesn't include the cost of owning a house. They do something called owner's equivalent rent, which is inaccurate. And the increasing numbers are phased in over a 6-month period. So you are going to, as the high numbers, rents are actually up 15 to 20% around the country, new rents. So as you see those things phase in, as people move, get new contracts, as the owner's equivalent rent numbers are included, over the past moving average, those numbers can for that sector of the CPI are only going to get higher. And that's going to ensure, because there's such a high weight, that's going to ensure that the CPI itself stays elevated. So we're going to have excitement about this for months and maybe years, no matter what else happens. So I just want to point that out.
Excitement is a generous way to put it.
Yeah.
But I think your point, historically, people should understand that inflation of the late 1970s, early 1980s really started in the early 1970s, late 1960s. So this was not a flash in the pan, a couple of years, even as today's politicians, I think, would have you believe it's transitory, it's not here to stay. Rand talked about, this is quoting from the essay Moral Inflation, the expansion of a country's currency, which incidentally cannot be perpetrated by private citizens, only by the government, consists in palming off as values a stream of paper backed by nothing but promises or hot air, and getting actual values, the citizens' goods or services, in return until the country's wealth is drained. Put that into everyday English for us. What does that mean?
One way to think about it is, if it costs nothing to create money, costs or virtually nothing, and it's distributed to people who have a claim on wealth, what they've got is purchasing power without ever having put anything into the system. Normally, we think of earning money. We think of giving something of value to someone else and in exchange getting money. This is not what happens under inflation. And my particular interest is how many different ways the government has figured out to get money to the people it wants to get money to for when they actually did nothing to earn it. And they're getting more and more creative with that, as we've seen during QE and then during the pandemic response and the directed lending with the banks with the triple P and all the acronyms that, the CARES Act and so forth. They're getting very creative. And my view is this is going to continue and that they have to keep doing it for a variety of reasons, which I don't know if we want to get into that today, but
Rand has that quote, I believe, from the essay Egalitarianism Inflation, where he talks about, in effect, I'm paraphrasing, if you took a bunch of savages and wrote them a paper check and let them go buy some things, you think, well, the more blank checks we write, right, the more you're stimulating the economy. So there's that whole kind of built-in, but economic, but also kind of practical as well. I mean, one thing we were talking about is that corporate America is blamed for short-term thinking, but what makes you think more short-term? I mean, you're a business expert. You have to think long-term, right? Rand talks about that. But inflation makes everyone think short-term because you don't know what prices are going to be like tomorrow. You don't know what input costs are going to be like.
Can I use a great example of that? So, I was for many years an investment analyst, and the firm I was with, we studied firms worldwide. I mean, we took equity positions all over the world. And so Brazil comes to mind. And when the real devalued in the late 80s, early 90s, as I recall, guess what businessmen got really good at doing? They got really good at barter. They started, instead of holding the Brazilian currency, they got very good at learning how to purchase and store warehouses full of soft drinks, specifically Coca-Cola. Coca-Cola became a currency for a couple of years. They would, and they would put it in a warehouse. That was their cash. The price would go up in reals. Then it was time to buy something. They'd cash in for the increased reals and go buy. I mean, that is when you have to spend your time thinking about how to buy and purchase an item for barter. That is an interruption of long-range thinking, and that is an interruption of really good economic planning. Sound money is key to a rational, growing economy. And when you, to the extent that you undermine it, you're undermining everything about the economy.
Now, I appreciate you saying that, and also emphasizing that these disruptions are not inherent, in my opinion, inherent in a free market economy. All this type of inflation, this is something that is not caused by the supply chain. It's not caused by greedy businessmen. It's caused by government artificial expansion of the money supply. That's at least Rand's, paraphrasing Rand's definition. So, well, let's look, because we wanted to kind of highlight some, not investment recommendations, of course, but some big picture thinking. Jim has studied all asset classes across all different periods of time. Maybe we'll even talk a little crypto as well. I'm sure you probably know more than I do.
I doubt it, but go ahead.
Well, I've studied Charles Ponzi, so I know about that.
Okay.
Here's from MarketWatch.com. They took a big picture look after inflation, and whenever you're talking about returns, unless you're including inflation, you're almost picking numbers out of a hat, it seems. So here's their after return inflation from 71 to 81. And, let's even skip what did well, but even look what did poorly, Jim. I mean, the S&P 500, you lost 16% in that year after inflation.
Yeah.
In corporate bonds, safe corporate, AAA corporate bonds, you lost 23% after inflation. Government bonds got absolutely annihilated. So inflation kind of turns everything on its head, because those are the assets that are supposed to be safe and good for the long term.
Yeah, I mean, I'm glad you showed that chart, because it highlights one of the things I was going to say today. Wanted to get in, and I'll just make the point now. Under conditions of inflation, I would be very careful about buying long-term debt obligations. In other words, being a lender to anyone long-term at a fixed rate. And you saw in that chart what happened to long-term bonds, long-term corporate bonds, even utility stocks. Now think about utility stocks. Utility stocks you think are safe. Utility stocks do raise their rates when inflation goes up, but it's with a big lag. In other words, you might wait for several years. Inflation can be up 20% over 3 years. You might wait that long for a 10% rate, for the utility to get a 10% rate hike, which would then translate to your dividend and in the stock that you own. So you have to be very careful about looking at the cash flows of the investment you're involved with and see if they're sensitive to increases in inflation or not. In the cases of utilities, they would have not served you well. And that's the way the utility rate hike mechanism works. And of course, the rate hikes are translated back to the dividends that you get as an investor. So probably not the best first place to look for an inflation hedge. On the other hand, energy, oil is bound to go up. Everyone's always going to buy energy, and the price is rather inelastic. A lot more money floating around. The price is probably going to go up. And if you look now, energy is performing extremely well. Energy stocks are performing extremely well, and they would be, carefully, they would be on my recommended list for sure.
Thank you, Marilyn, for your donation. Thank you all of the Super Chat donations. Keep them coming in. You're helping keep the lights on here. Not our lights, but more Master Razi's lights as well. They should be kept on, because he's helping provide all this interesting programming from really, and not only just esteemed objectivists, but esteemed economists and great people as well. So, I get frustrated about this whole topic, Jim, because these are some of your points, your big picture points, that during inflation, your first objective is to preserve wealth. Your second objective is to build wealth if possible. And for me, there's just this sense of frustration that inflation makes this process of investing so difficult, so cumbersome. Because as you said, you're not just figuring out how many Huggies Walmart's going to sell in the next 3 months. You got to figure out, well, what is their fuel costs going to be relative to higher inflation? As you said, the Build Back Better inflation, which is going to cause even more. So there's all these unnatural, state factors, I think, that make investing so much more difficult. That, as you said, it's building wealth is almost a second point than just keeping it during inflation.
Yeah, and I would say that the first thing you should do is think about preserving what you have. And I think you just made the point, I'll reiterate it. You may not be totally successful. I mean, the fact is, inflation is going to hurt everyone, and it may eat into your real wealth, even if your nominal dollar wealth goes up. So I would do the best thing. I would relax, do the best you can. I mean, don't get mad like I do. I mean, do the best you can. And you know, one thing that, oh my gosh, Jonathan.
Oh, sorry, no, I'm sorry. I didn't want to interrupt you, but I
thought that whole stack was going to come tumbling
no,
down.
no. Please continue.
Okay, you got me. You got me. So one of the things I think is pretty important to do is, you know, you can look to the place that we were just talking about that is a big factor in reported inflation, and that is the cost of shelter. I think it's a very good idea to own a home as a defensive move. Now, it's true that, you know, a home, it costs you money to keep it up. And it's true that the prices go up all the time, but that's one of the reasons it's a good inflation hedge. But I think we're going to see an increasingly repressive economy and an increasingly interventionist government in the next 10 years. I believe that. That's the trend. And I see logic from their point of view as to how they're going to control this inflation and help to pay down the debt that the Treasury owes and that the government is obligated to. And so
I would have to imagine, just jumping in briefly, I'd have to imagine too quickly on real estate that, as they say, that, you know, the three rules that, you know, real estate, location. Obviously, that
right.
One has to be pretty selective about what particular parcel.
Right. No, right. Of course. Yes. How, and, you know, this house and that house are not the same. They're not fungible. So, but yes, so you need to be very careful. So that huge disclaimer, you do your homework, you buy in an area where you have every reason to think that, you know, demand will continue to increase. You take advantage of low mortgage rates subsidized by the government. I mean, in this case, be a borrower, not a lender. But here's the thing to me that people miss. Home ownership is a very deeply entrenched prize sort of in the American psychology and probably in other places too. It's very popular with the middle class, and it's unlikely to me that the advantages of it will be taken away by politicians. In other words, I think it's the last place that government's going to violate your property rights. My view. So it's better. It is a form of forced saving because you have this mortgage payment to make, you know, every month. But you may not actually, quote, keep up with inflation. You probably will. But it's also a place of sanctuary and relative safety in a crazy world. And my view is a single family home, which is where the trend is now and probably I think will stay for a while, is in a good area, pretty good bet to preserve wealth and maybe build it. So I would class this as a defensive kind of a investment sort of.
One of the projects, one of the entities we work with is a precious metals firm, and they were kind enough to send over this photo of you, I guess, diving into, is that a big bucket of gold or a big room of gold? It doesn't look like you. No, I'm joking, of course. It's Scrooge McDuck. On your list is owning some precious metals. That's what we think about, right? By metals, you think about a huge room of gold, but you're not talking about that when we talk precious metals. Right. That's kind of the old way of thinking. What does that mean, own some precious metals? Okay,
good. So this, again, would be a pretty defensive thing. Now, you first of all, don't be intimidated by all the pricing and the marketing and all the, quote, analysis and opinions you get about precious metals. I'm talking about thinking very long term. I mean, I would say probably everyone here has a reasonable understanding of the history of gold and silver to a lesser extent, in the history of money. It is the money chosen by the market, and there's no question in my mind it would be the money chosen by the market if we had not had fiat money take over. So probably the big thing to me about owning gold, owning precious metals, is that by owning it, you are independent from the financial system. You buy it. If you have a reasonably small amount, you keep it in safekeeping in your home. If you have more, you should put it under professional storage, and where it's very safe. But it is independent in the sense that the bank, if the bank fails, or it can't be inflated. It increases in value in the amount of gold that gets added to all the gold that was ever produced is about 1 to 2% a year. So no one can create all the gold that ever existed still exists.
Yeah, I mean, I think that is, it's funny.
You have a choice of whether to hold it or not. You don't have a choice of whether to hold dollars or not. It's independent. It is independent from the financial system.
A friend, Stuart Hayashi, made the point that, if you left an heir a share of stock, or some of the old ways they used to save, like seashells or fruit or whatnot, or beads, or even something like corporate bonds or bonds, like in 10, 15 years, you would have no idea what that would be worth. But you put 10 ounces of gold there, you know exactly what it's going to look like. Its value is not going to be dramatically different, and it will preserve that purchasing power, as you said, with no debt on it, with no encumbrance on it, with no claim on it.
Well, see that you just listed by observation some of the major factors that made gold money, why it became the money of choice in markets all over the world. So, I mean, it's, if you own it, it's private for the most part. You can keep it private. I just want to anticipate something people may say. They may say, well, gold became illegal to own in 1933 in this country, during the under the Roosevelt administration, it was illegal to own gold. And that, quote, privilege to own it was reinstated in 1975, I believe. Now, because it was reinstated, I find it difficult, and because gold it's not considered important anymore by most people. I think it's unlikely that gold would be confiscated from you. It would be almost impossible to do it. I'll tell you one thing, they'll never find mine. So, so I mean,
okay. Let me play a little devil's.
It's a good way to save money for a long term. If things go well, it's going to stay relatively stable in dollar value. If things go badly, the dollar is going to, depreciate against gold. The gold price is going to go sky high. If things go really badly, either way, you're going to be better off if holding gold for a long period than you would be holding cash for a long period, in my opinion.
I certainly, history bears that out. I agree. And it's funny, the term store of value is thrown around a lot these days, until you realize it's hard to, one of the difficult things about creating values is knowing how to store them. Your number one was protecting your wealth, protecting your values. And, historically, gold has certainly been one ideal way to do that long term. What not has been, one of the things you talked about when we first started was avoiding long-term bonds. So take us on a 30-second reminder of the inverse relationship between interest rates and bond prices, because people lose money on bonds, like interest rates are going up.
Yeah, I could have mentioned that when you showed your chart. Yeah, as rather than give a long explanation, the interest rate and bond prices are inversely related. As interest rates go up, bond prices that have a fixed rate of interest will go down, and vice versa. As bond prices go up, that pushes the interest rate on that fixed rate instrument down, and that pushes other interest rates down. Let's put it this way. Let's suppose you have a $1,000 bond that pays $50 a year, and the Fed comes along, and that's 5%. Okay, 50 over 1,000. This is a forever bond. We're going to take away maturity to make it easy. Now the Fed comes along and pays $1,250 for that bond. The that bond is now worth $1,250, but it still pays $50 in interest. The interest rate on that bond is now 4%. And when there is a market out there that's willing to buy that bond, buy bonds for 4%, all bonds will tend to gravitate to 4%. So when the asset price went up, the interest rate went down. And it would be the same the other way.
And one of the things we've seen, just for those maybe who haven't been following the financial markets this much, thank you, Frederick, for your contribution. Thank you, Marilyn, for your contribution as well. You know, one of the things that we've been seeing is a steady rise in interest rates. Even before the Fed has done anything, we've seen short-term interest rates go dramatically higher. I mean, long-term and short-term interest rates go dramatically higher. And people don't realize this, Jim. As you know, you can lose money in bonds. People say, oh, bonds are safe. But this is some data. The average real bond return during these high inflation periods is negative 2.8%. They kind of aggregated all those. So in periods of high inflation, you're not saving money in bonds, you're losing money in bonds. That's something I think people don't realize. Well, I'm gonna keep it in bond. Of course, I'll save money, but you're not.
Yeah, and at the very least, even if you hold the bond to maturity and you'll get all your principal back, but you'll get it back at such a low rate of interest, you won't be happy. And that's the point. If you have a long-term bond and you have to sell it any time along the way between now and when the principal returns, you are going to lose money. So, and buying a fund won't help you either, because the fund just holds the same instruments inside it, and they have the same problem inside the fund. I mean,
it's something, again, that, you know, even today's retirees who are more fixed income oriented have probably never really seen or witnessed. And you know, this is uncharted water for a lot of American investors, a lot of global investors.
Yeah,
you mentioned
and you know, it's true. We haven't talked about it much, but people who are on fixed pensions, fixed income, you know, and don't have any way to increase their income during the cost of living rises, they suffer a lot. Now, could I just mention, this might be a good time to mention that an alternative to that might not be perfect, but how about looking at equity stocks that have a good history of paying dividends and raising their dividends as earnings go up? These are called dividend growth kinds of companies. And if you get the right kinds of companies and you can buy them at the right price, and they raise their dividend as you know, prices go up, they make more money, their dividends go up, they raise their dividends. So it's not a perfect inflation protection, but it's pretty good over a long period. Dividend growth stocks will probably perform with inflation, but with a lag. And at least you have a way of, you know, preserving your wealth and growing slowly.
Well, you know,
by the way, that's mostly what I've been in for many years, dividend growth stocks.
Well, I mean, I consider you the smart money. One of the things you recommended was to notice what the smart money is doing. Now, I don't know, were you talking about Jim Cramer? Is that true? I don't know, maybe. Or maybe you were talking about insider trading.
No, I was not talking about Jim Cramer.
All right, my bad. Excuse me. Like, when you say follow the smart money, I mean, everyone thinks he or she is the smart money, right? I mean, who?
Okay, is Bill Gates smart money? Yes. Is Warren Buffett smart money? Yes. So keep your eyes open. You know, I don't know. Name a great tech guy. Is Peter Thiel or Peter Diamandis? You know, these guys, are they smart money? I would say yes. Some of the things they do you may not be able to do. But if you hear that Warren Buffett is concerned, and if you just do general reading, you'd find this out. Warren Buffett is concerned about inflation and is therefore buying Japanese trading companies that have exposure to commodities and commodities brokerage. Don't go out and just buy it, but investigate that. And if you hear that Bill Gates has now become the largest single owner of farmland in the country, investigate that. There's a good reason.
That's on your list as well. And, you know, you talked about farmland generally holding its value.
Yeah.
Now, this is not a photo of you, but I mean, if someone is interested in farmland, are they going to have to get the whole denim shirt? I know there's some ETF, or not ETFs. This is land is a REIT, a real estate investment trust that holds farmland. It's done quite well, really, since November. It's up about 30%. How would someone who wants to be in farmland as one part of their portfolio?
Well, as you say, you can, generally the way you invest in farmland is you invest in the land and then lease it to the farmer. And the return on the leases are tied to the value of the crop. Now you can either own the land and do that directly, which is hard because, farms cost millions of dollars today. Or you can invest through partnerships that do that investing for you. Or you can, as you're saying, buy a vehicle like a real estate investment trust that does the same thing, only it's publicly traded. And these things can be, one good thing about a REIT, there's good things about REITs and bad things. One thing about a REIT is it can get overpriced because it trades on people get all pumped up about it, and then you're not necessarily buying the underlying asset at a good price. But it can also get underpriced. It can get sold off, and you might be able to pick it up for a real bargain. So you have to do your homework with these things. But yes, farmland has held up well over the years. It gets typically, in non-inflationary years, it typically gets high single-digit returns. And then in inflationary years, it gets low double-digit returns. As opposed to, say, the S&P 500, which gets, in recent years particularly, gets double-digit returns. But then you have a year like, where it's down 35%. And, you have to panic. So it's a good diversifying investment.
Well, one of the things, those evil masters of the universe, I guess they said they're SOBs now on Wall Street, that in fact has been such a benefit now, is that there's innumerable products now that let you participate in a lot of these markets that, forget even the 70s, even 10 years ago, you couldn't really participate in. Now, these are not recommendations, just observations. Jim, you talk about some commodities exposure, and even if, these are just some ETFs that track commodities, and this top one is the Basic Commodities Index, DBC. JJT tracks tin. Now, of course, there's expenses, and, do your own due diligence, but here's one, there's all these ways that if someone wants commodity exposure, not all or nothing, not balls to the wall, but as one part of that portfolio, they can do it. They couldn't do that a decade ago.
You're right, and there certainly is that exposure. Now, I'm going to say these things are not necessarily no-brainers, and we're now, as we talk here, we're getting more and more kind of out on the risk spectrum.
Yes.
You can get pretty violent short-term moves, and it's hard to stay in when you don't really know. There's also underlying expenses to trading commodities. There's the roll cost and the underlying costs that don't show up in the net asset value. So commodity, there are different kinds of commodities. For example, you can buy a gold ETF that has a very small expense ratio. My guess is an oil ETF that trades commodity contracts has a bit of a higher expense, and that's going to eat into your return. So be careful. You have to do your homework. But yes, you can get the exposure to elevating assets by all these things. And I agree with you. It's really amazing that these things have been financialized so that the average person can either get in and either prosper or get killed.
Well, I'll just throw one more disclaimer about leverage. One of the I guess good and bad is now they offer a lot of products that are 2 and either 4 times leverage. These are really specialized, I think extraordinarily dangerous. They're actually not meant to be held for more than 1 day. So these I would basically, for most people just avoid writ large. But as Jim said, do your due diligence, do your own homework, and investigate these as one part of a portfolio. What about
there's just all kinds of things. To suppose you take interest in lithium because it's so important in batteries because of the growing popularity of electric vehicles and electronic instruments. Well, you can invest in lithium, and you can invest in companies that produce lithium. And this is something you have to be very careful of. But if you want to get that specific about that kind of commodity, you can do that. So I just want to throw that out there. There's no limit to what you can become expert in if you want to try.
You had mentioned asset-light companies, and I thought it was kind of interesting because people might not know that term. This is what a quick Google search said, that like Uber, Airbnb, Instacart are asset-light companies. What do you, with pricing power, what are you talking about when you mention asset-light companies for investigation?
Yeah. So what if you think about a company that's not asset-light, that's asset-heavy, that takes a heavy machinery or heavy fixed investment, material investment to produce its product? Well, that product gets used up and has to be replaced at higher prices. Mm-hmm. But it's expensed, for example, depreciation on a complex machine is expensed on a fixed rate. So suppose the value of that machine or the replacement cost of that machine keeps going up, but you're only depreciating it at its original cost. It's likely you're not going to be after you pay taxes on that false profit. It's likely you're not going to be recovering enough to replace that machine. Therefore, you're going to have a hard time pricing for that product to replace that machine. It's just really hard to see that. And so,
could you give me 2 or 3 names in today's? These aren't recommendations, but types of names that are asset light.
Okay, those are asset heavy. So, but by asset light, I would think software companies, brokerages, anybody a company that's, for example, that matches up buyers and sellers, even a shipping broker, or a broker who benefits from transactions. 2 things happen under inflation. First, you get a lot of volatility, and that means more transactions. And every time there's a transaction, you get a little more piece of that broker takes a little slice in between the transaction. So as you grow transactions and as asset prices increase, you have to add capacity. How do you do that? You don't have to add people, add a server. It's very inexpensive to add capacity to some of these exchanges. And I could name them, but you could, and they're all over the world. Every country has several. So these are interesting if you buy them at the right price. Those are asset. So basically, someone who doesn't have doesn't have to increase employment a lot to increase sales, and doesn't have to increase assets a lot to increase sales. Just think that way, I think, and you'll get on the right track.
The last one on your list, and I want to encourage all the super chatters. Now's a great time to get in with any questions for Jim. Art and collectibles. This is it's pretty unusual. I mean, art as an investment, oftentimes it's kind of more thought of that as more of just a personal hobby or pleasure. Is it something really you think that people could put and should put substantial assets towards?
Not me, but I put it out there as to show what I think is the spectrum. And as art goes up in price, and it usually does in inflationary times, you can also buy shares in art auction houses and so forth that might benefit from that. So you could think about that. Mm-hmm. Jonathan, can I mention one thing before we wrap up?
No, of course. Yeah.
Actually, my favorite investment in inflationary times is investing in mineral, either precious mineral or resource royalties. And there are a number of royalty trusts that you can buy. A number of royalty trusts that you can buy on the exchanges. And the way a royalty works is, suppose I have a royalty in an oil well. That means that what I have done is I have given the oil well developer money to develop his well, and in return, he gives me a perpetual royalty on the sale of the oil off that well, maybe 20% of it forever. If the price goes up, I get more. If the price goes down, I get less. But I have in perpetuity a right to a certain percentage of every sale that comes off that mineral right. So when you buy mineral royalties, and there are companies that form around this, what are the costs of running that? Practically zero. What is the upside when the commodity price is increasing? Unlimited. And
Daniel,
and in addition, there's an option value, because when you buy a royalty interest in minerals, a mineral interest, you buy everything that will ever happen under that ground in most cases. So if they discover, if it's an oil well, they discover coal or they discover diamonds, you're going to be in on that. So this is a really interesting one. Now you have to be careful about, this is the best business model as an investor I have ever come across, because the costs are so low and the upside is so great. And you'd have to be careful about buying them, but long-term, if you're willing to hold these long-term, eventually they do well. Now you look at, there's a lot of gold royalty trusts out there today. They're a little bit elevated. If you look at them, be careful, but you can start accumulating them and adding them and give them to your kids someday.
Daniel,
that's my best idea.
Daniel wants to know if you have an opinion on self-storage investing.
Oh, that doesn't sound bad, does it? I mean, it would depend, obviously, very much. It's real estate. It's very local. It's location. But as a business, you would think there would always be a demand, and you would think this is very low maintenance, and you'd think this is basically mailbox money, right? That probably goes up with inflation. Yeah.
I'm struggling now because I know there's a bunch of real estate investment trusts that in particular focus on self-storage investing. So certainly one area, to investigate. Maybe kind of tallies back to what we were saying before, that people think, invest in the markets. They think Microsoft, Google, Apple, but there's a whole wide world out there of different types of investments that even can participate in some of these rocky economic waters that are already upon us. So you just have to, as you've been emphasizing, do your due diligence and do your homework and find what works.
Yeah, I would be very careful about jumping into the 7 big techs at these levels. I'm not saying don't do it. I'm saying at these levels, it's risky.
Well, what isn't risky, I know you would agree, is being a student of objectivism that only pays dividends, supporting the Ayn Rand Center UK, supporting the Ayn Rand Institute, supporting all these groups that are bringing you great speakers, great insights, talks about Ayn Rand, and a community. Jim made the point, you don't remember it. You were way too young, but in the 60s and 70s, everyone was in New York smoking and hanging out talking about ideas and having that community of young objectivists. And we are building that here with all these exciting experts and young people from across the globe. So thank you for being part of that. And at the bottom of this hour, which is coming up in just 11 minutes, Mark Pellegrino. We're going to talk about huge star Mark Pellegrino, Jack Schulman, Jennifer Barandi, and Rucka Ali, all doing TV talks. So to me, it's fascinating. We're talking economics, we're talking investing. It's a whole world of things that influenced by objectivism. So thank you for being part of it.
Jonathan, I sure enjoyed this. Thank you. It was great talking with you. I felt like we could have done this in your living room or my study or something, and it was just a nice chat. And I hope somebody out there got an idea and benefited in some way.
I know they did. We've had a lot of great reaction in the super chat. Everyone should share this program, like us, promote us, become a subscriber, and we'll do it again. We'll bring Jim Brown back soon. He'll be back on the channel again soon. So till next time, have a great, safe, peaceful weekend. And thanks for being part of the Ayn Rand Center UK. See you soon.
Here's everybody.